In 1873, the German Empire made a decision that seemed entirely rational at the time. They demonetized silver. Within a decade, the global price of the metal had collapsed by more than 40%. Mines closed. Entire regional economies built on silver extraction simply vanished. But here's what most people missed. The collapse wasn't caused by a lack of silver in the ground. It was caused by a sudden, irreversible shift in what silver was for. Today we're watching another transformation. Silver is disappearing from global markets at a pace that would have seemed impossible just 15 years ago. But this time it's not governments making the decision. It's solar panels. It's electric vehicles. It's the infrastructure of artificial intelligence. And the industries consuming this metal have no plan for what happens when there isn't enough left. For most of the past century, silver existed in a kind of equilibrium. It was a monetary metal that had lost its monetary function. It was an industrial commodity that nobody worried about running out of. It sat in vaults, in jewelry stores, in photographic film, in electrical contacts. It was everywhere and nowhere at once. And because it was so abundant, so widely distributed, so deeply embedded in the background of industrial life, no one thought to ask a very simple question. What happens when an abundant metal stops being abundant? The Romans had silver. They mined it in Spain, in Anatolia, in the mountains of the Balkans. For centuries, the Roman economy ran on silver coinage. The denarius was stable. It was trusted. It was the foundation of trade across 3 continents. But by the 3rd century, the Romans had a problem. The mines were still producing. The soldiers still needed to be paid. The empire still needed currency. And so they did what seemed logical. They reduced the silver content of the coins. At first, no one noticed. A coin that was 90% silver became 80% silver, then 70, then 50. The coins still looked the same. They still circulated. But slowly, imperceptibly, confidence began to erode. Not because the coins were worthless, they weren't, but because everyone began to understand, at the same time, that the system depended on a resource that was quietly running out. Silver became the backbone of solar panel technology almost by accident. In the 1970s, when the first photovoltaic cells were being developed for space exploration, engineers needed a metal that could conduct electricity with almost no resistance. Silver was the obvious choice. It was the most conductive element on Earth. It didn't corrode. It performed flawlessly in extreme conditions. And at the time it was cheap. For decades, this didn't matter. Solar panels were niche products. They powered satellites, remote weather stations, experimental homes in the desert. The amount of silver required was negligible. But then something changed. Governments began subsidizing renewable energy. China began building solar manufacturing capacity at a scale the world had never seen. And suddenly, silver wasn't a niche input anymore. It was the critical material in the fastest growing energy infrastructure in human history. By 2010, solar panels consumed roughly 35 million ounces of silver per year. By 2020, that number had doubled. By 2023, it had doubled again, and the projections for the next decade suggest that solar panels alone could consume more silver annually than the entire global mining industry can produce. What made this transformation invisible was its gradual nature. Silver didn't disappear overnight. It disappeared incrementally, absorbed into products that were being mass-produced and installed across every continent. Each individual solar panel contains only a small amount of silver, perhaps 20 grams. But when you're manufacturing 600 million panels a year, those 20 grams add up. The same pattern emerged in electric vehicles. Early EVs used modest amounts of silver in their electrical systems. But as battery technology improved, as charging speeds increased, as vehicles became more digitally integrated, the amount of silver per vehicle began to climb. A modern electric vehicle contains anywhere from 25 to 50 grams of silver in its battery management system alone. Multiply that by the 20 million EVs projected to be sold annually by 2025, and you're re-looking at another 500 to 1,000 metric tons of silver disappearing into a product category that didn't exist 20 years ago. Then came artificial intelligence. The data centers required to train and operate large AI models are among the most electrically intensive structures ever built. They require power distribution systems that can handle sudden massive surges in demand, and the most reliable way to manage that kind of electrical load is with silver contacts, silver relays, silver bus bars. Every expansion of AI infrastructure is, functionally, a withdrawal from the global silver supply. What made this rise feel stable was the assumption that supply would adjust when demand for copper increased in the 19th century. New mines opened. When demand for aluminum surged in the 20th century, production scaled. The market, people assumed, would simply produce more silver. But silver doesn't work that way. In 1545, Spanish prospectors discovered a mountain in what is now Bolivia that contained more silver than any deposit ever found in human history. The mountain was called Potosi, and for the next century, it was the single most valuable piece of real estate on Earth. At its peak, Potosi produced more than half of the world's silver. It funded wars, built palaces, and underwrote the Spanish Empire's global ambitions. But by the early 1600s, something began to change. The richest veins had been exhausted. Miners were digging deeper, extracting ore that was more difficult and more expensive to process. Output began to decline, and yet the Spanish crown's expenses did not. The empire was locked into a system that required enormous quantities of silver just to function, to pay armies, to service debts, to maintain trade routes. The collapse was not sudden. It was a slow, grinding erosion. As silver production fell, the crown debased its currency. As the currency was debased, inflation accelerated. As inflation accelerated, the real value of silver holdings declined. And as that happened, confidence in the Spanish economy began to evaporate. By the mid-1600s, Spain, the wealthiest empire in Europe, was effectively bankrupt. The lesson wasn't that Spain ran out of silver. It was that Spain built an entire economic system on the assumption that silver would always be available in the quantities required. When that assumption failed, the system failed with it. In the late 1970s, two Texas oil billionaires named Nelson Bunker Hunt and William Herbert Hunt became convinced that inflation was going to destroy the value of paper currency. They decided to buy silver not as an investment, but as a hedge against the collapse of the dollar. Over the course of several years, they accumulated more than 100 million ounces of physical silver, roughly 1/3 of the world's deliverable supply. At first, the strategy seemed brilliant. The price of silver began to rise. $5 an ounce became 10, then 20, then 30. By January 1980, silver briefly touched $50 an ounce. The Hunt brothers were, on paper, among the wealthiest individuals in the world. But the market had become distorted. Industrial users of silver, electronics manufacturers, photography companies, jewelers found themselves unable to secure supply at reasonable prices. They stopped buying, they began substituting other materials. And when the price of silver finally broke, it didn't decline gradually, it collapsed. Within 3 months, silver had fallen from $50 to below $11 an ounce. The Hunt brothers were wiped out. They had borrowed heavily to finance their purchases, and when the collateral value of their silver holdings evaporated, they defaulted on more than $1 billion in loans. But the deeper damage was structural. The market had learned that silver could be hoarded, it could be cornered. And when that happened, the industries that depended on it simply found ways to use less of it or to stop using it entirely. The question no one asked at the time was this: what happens when the buyers are speculators, but entire industries that have no substitute? The breaking point for silver is not a moment, it's a threshold. And that threshold is reached when annual industrial demand permanently exceeds annual mine production. According to data from 2023, global silver mine output was approximately 830 million ounces. Industrial demand, including solar panels, EVs, electronics, and AI infrastructure, exceeded 900 million ounces. For a single year, this gap can be filled by recycling, by drawing down above-ground inventories, by melting jewelry or selling coins. But when demand exceeds supply year after year, those buffers disappear. And unlike oil or copper, silver is not easily substituted. There is no material with comparable conductivity that can be deployed at scale without redesigning entire product lines. The solar industry has known about this problem for more than a decade. Engineers have been working to reduce the amount of silver used in each panel. In 2010, a typical panel required about 130 milligrams of silver per watt of capacity. By 2023, that figure had fallen to around 65 milligrams. But during the same period, the total number of panels being manufactured increased by more than 500%. The efficiency gains were overwhelmed by the scale of deployment. Tesla, the world's largest EV manufacturer, has been similarly constrained. The company's battery management systems rely on silver for thermal and electrical stability. Attempts to replace silver with copper or aluminum have resulted in performance degradation, particularly in fast-charging scenarios. And as Tesla scales production toward its goal of 20 million vehicles per year, the amount of silver required increases proportionally. What makes this moment dangerous is not that the technology will stop working. It is that the industries built on this technology have no plan for a world where silver is rationed. When a critical material becomes scarce, industries don't collapse all at once. They fracture. The strongest companies secure supply through long-term contracts, vertical integration, or by acquiring mining assets directly. Smaller companies are priced out. They delay production. They redesign products. They fail. In the 1970s, when palladium became scarce, the automotive industry spent billions developing catalytic converters that used less of the metal. But the transition took more than a decade, and during that period, vehicle production was constrained, prices rose, supply chains fragmented, and the companies that couldn't adapt simply stopped manufacturing. The solar industry is larger, more globalized, and more politically sensitive than the automotive industry of the 1970s. Governments have mandated renewable energy targets. They've subsidized installations. They've built entire climate strategies around the assumption that solar capacity will continue to expand at exponential rates. But if the silver required to manufacture panels becomes unavailable or prohibitively expensive, those plans become unworkable. The fallout won't be a sudden crash. It will be a series of quiet failures. Projects will be delayed, costs will rise, installations will slow, and the political pressure to meet climate targets will collide with the physical reality that the materials required to meet those targets are no longer abundant. The instinct, when faced with resource scarcity, is to find a substitute. The solar industry has pursued this aggressively. Copper is the most obvious alternative to silver, and some manufacturers have experimented with copper-based contacts. But copper oxidizes, it degrades over time. It reduces panel efficiency by anywhere from 2 to 5%, which, over the 25-year lifespan of a solar installation, translates to significant losses in energy output. Other companies have explored aluminum, graphene, and even conductive polymers. None have matched the performance of silver, and none can be deployed at the scale required without redesigning manufacturing processes that have been optimized over decades. Recycling has also been proposed as a solution. In theory, the silver embedded in old electronics, decommissioned solar panels, and scrapped vehicles could be recovered and reused. But the recycling rate for silver is currently below 20%. The metal is dispersed across millions of small devices. It's expensive to extract, and the infrastructure required to scale recycling to industrial levels doesn't exist. The most telling failed fix, however, is the one that hasn't been attempted: reducing consumption. No government has suggested building fewer solar panels. No automaker has proposed manufacturing fewer EVs. No AI company has volunteered to scale back its hardware expansion. The entire system is predicated on the assumption that growth will continue, and that the materials required to sustain that growth will simply materialize. History suggests otherwise. In the Roman Empire, the debasement of the denarius didn't cause an immediate crisis. It caused a slow erosion of trust. Merchants began weighing coins instead of counting them. Soldiers demanded payment in gold instead of silver. And over time, the entire economic system restructured itself around the absence of the material it had once taken for granted. Today, the solar industry is beginning to exhibit similar patterns. Panel manufacturers are stockpiling silver. They're locking in supply contracts years in advance. They're quietly raising prices, not because of tariffs or labor costs, but because the input material is becoming structurally scarce, and companies like Tesla are facing a decision they didn't anticipate: whether to secure silver supply at the expense of profitability, or to risk production shortfalls in a market where demand for EVs is still growing. The pattern is not new. It's the same pattern that played out in Potosi in the Hunt brothers' collapse, in every resource-dependent system that failed to recognize its own limits. Across history, resource exhaustion follows a predictable sequence. First, there is abundance. The material is cheap, widely available, and taken for granted. Second, there is expansion. Industries scale production, governments subsidize deployment, and consumption accelerates. Third, there is denial. Even as inventories decline and prices rise, the system assumes that supply will adjust. Fourth, there is scrambling. Companies hoard. Substitutes are tested and fail. And fifth, there is restructuring. The industries that depended on the material either adapt or disappear. We are currently in the third stage. The data is visible. Global silver deficits have been documented for 3 consecutive years. Prices have risen, though not dramatically. And yet, the industries consuming silver, solar, EV, AI are still planning for exponential growth. The fourth stage will begin when inventories are exhausted and prices spike. At that point, companies will realize that the material they assumed would always be available is no longer available at any price, and the industries built on that assumption will be forced to make choices they are not prepared to make. What makes resource scarcity difficult to process is its invisibility. Silver doesn't disappear in a dramatic fashion. It disappears incrementally, absorbed into products that are distributed across the world. A solar panel installed in Germany contains silver that will never be recovered. An EV sold in California contains silver that will sit in a driveway for a decade, and a data center in Virginia contains silver that will remain embedded in electrical systems until the facility is decommissioned. The psychological response to this kind of depletion is always the same. People assume someone else is managing the problem. Investors assume companies are securing supply. Companies assume governments are stockpiling reserves. Governments assume the market will produce substitutes. And everyone assumes that the system, which has functioned reliably for so long, will continue to function. But in the Spanish Empire, no one managed the problem. The silver simply ran out, and the system adjusted violently, chaotically, and at enormous cost. The same thing happened in the 1980s silver crisis. The market assumed supply was infinite, and when that assumption failed, the correction was brutal. What's unnerving about the current moment is how quiet it is. Solar installations are still growing, EV sales are still rising, AI infrastructure is still expanding, and silver is still being consumed at rates that exceed production. But there's no crisis, no headlines, no panic. This is the silent phase. The phase where the data is visible but the consequences haven't materialized. It's the phase where everything appears stable, even as the foundation is eroding. And it's the most dangerous phase, because it's the phase where decisions could still be made, where industries could scale back consumption, where governments could prioritize recycling, where companies could invest in substitutes. But that's not what's happening. What's happening is acceleration. More panels, more vehicles, more data centers. The system is consuming silver faster than ever, and no one is asking what happens when there's none left. In 1873, when Germany demonetized silver, the decision was framed as progress. The gold standard was modern, it was efficient, it was the future, and the collapse of silver prices that followed was simply the market adjusting to a new reality. But for the miners, for the economies that had built themselves on silver production, for the industries that had depended on its availability, the adjustment was catastrophic. The metal didn't disappear. It was still in the ground, but the system that had given it value had moved on. Today we're building a system that depends on silver in ways no previous civilization ever has. We're embedding it in infrastructure that's meant to last decades. We're consuming it at rates that assume infinite availability. And we're redoing it without asking the question that every previous generation should have asked, but did you? What happens when the metal runs out?